Hello and welcome back to another episode of Fun Friday with a very special guest, typically a host, as he is a podcasting guru, seemingly. We have the founder of Cattani Capital and the host of Cashflow Chronicles, the one, the only, Jonathan Cattani. How are you today, sir?
Doing well, man. How are you?
I'm doing excellent, and I'm excited to kind of flip the table on you here, as you're usually the one in my seat. So, with that said, I guess, tell us about yourself and how you got to where you are today.
Yeah, great question, and thanks for having me on. It's a nice little home and home, right? I had you on. Now we're flipping it back, and it's nice being on this side when you're so used to hosting because uh, it feels like there's no pressure on you, right? You're the guest, so you just get to talk about yourself. So,
Yeah.
yeah. So to answer your question, let's see. So really, we'll just kind of start where I first started getting into finance. So college, kind of where I first obviously discovered it, like most people, and then really didn't get into it as a career until I became a stockbroker for a discount brokerage here in Salt Lake City. I got my Series 7 and my 63. Kind of quickly worked my way up to start working with our high net worth clients. Basically, where I was at, you had to have at least 5 million at the brokerage or more in total assets. And my role really was just to kind of get them to consolidate as much of their assets there as possibly could, white glove service, make sure they were happy. And that ironically is where I learned about real estate, because when you talk to wealthy people, you realize that they all have real estate in some form or fashion. And this was right as syndications were first kind of started to take off, right in the 2017, 2018 era. And so started helping people do paperwork with self-directed IRAs, for alternative investments. And of course, me being curious, just asking what they were doing and ultimately learning about syndications and really kind of deeper dives into real estate that led to books and podcasts. And ultimately, I ended up in 2019 just hating the corporate world. Everything got stagnant. There was nowhere to move, laterally or up. And so I left that world and joined the tech startup world. We have a lot of tech startups here in Utah. We've been dubbed the Silicon Slopes. So I joined that world, and quickly after COVID hit. And so I got laid off because of COVID. Took a bunch of time off and ultimately found a group here called Greenlight Equity Group, and they were buying apartment complexes in Columbus and Oklahoma City. Joined them on kind of the what is now I would realize is kind of the investor relations front. I helped them kind of build out their automations, you know, organize their webinars, and we basically went from about 5 million in AUM to about 60 million in AUM in just under a year. And I realized that my superpower skill set really was people, investor relations, and capital raising. So to kind of make a long story not so long anymore, I joined Raise Masters, met Hunter and Adam, and ultimately founded Cattani Capital Group in January of 22. So
Very cool. And then when did you get the crazy idea to become a daily podcast host? I think you've scaled that back slightly, but that's pretty ambitious to go into the space, basically head first and say, I'm going to do this. And just from my perspective, by the way, it is really nice to have a podcast because, selfishly, it's great for me to, learn more about you, but just to have the right people in our ecosystem. But then also you get to learn so much about people. So it's kind of a cheat code to networking, right? But what really gave you, the want to say, okay, I'm fully committed? Was it basically just like, hey, you're really going in the deep end, you're cementing yourself there? Like what was the thought there and the idea? Because, now everyone has a podcast, me, of course, included now, but seemingly there's a lot of them out there, but you have distinguished yourself as having a more prestigious and well-known one.
yeah, thank you. I appreciate that. That's a great question. So really what it came down to is I launched Cattani Capital Group. And because I was no longer working at Greenlight, I had nothing but time. So I was like, all right, like I'll see your weekly podcast, your twice a week podcast, I'll raise you a daily, right? And so ultimately it was for kind of the reasons you outlined, like A, I'm going to build my network much faster. B, I'm still new to the industry. I'd only been with Raise Masters since September of, September of 21. And this was basically, I launched in April, started recording in early March, maybe late February. And really the goal was just to flatten my learning curve as much as possible. So much like you've discovered, when you interview people who know way more than you, chances are you're going to learn something. Well, I just, you know, basically 5X that. So where most people might do, maybe one or two episodes or one or two interviews a week, maybe three, depending on your cadence, I was doing anywhere from probably 8 to 12 a week. So as you can imagine, over the course of a year, the amount of information that you're going to learn and retain, and especially when you're continually talking about it, right? It's one thing when you flood yourself with a whole bunch of information, talk about it one time, and then never talk about it again. But when you're constantly talking about it 8 to 10, 12 times a week, it's just sticking in your mind, right? And what was short term is now long term, and you're just constantly learning, and your network is growing. So I did that for a year. Finally got to my first raise and started building up like an actual investor list, and was like, okay, can't do this anymore. It's way too much work. And honestly was getting burnout. And so, shout out to like Whitney Sewell, who still does his daily. I know Joe Fairless does, but he's got guest hosts. Whitney has a guest host, but is still mostly doing his own pod. And it's funny because I talked to him at Best Ever last year. It's like, hey man, I'm still doing the daily. And we both kind of chuckled. We're like, in hindsight, I don't know that I would have done a daily knowing how much work it was.
Yeah.
There was a bit, I am kind of grateful for being naive in a bit, because I had no idea how much work was coming, but ultimately super grateful for it. And we've now tapered down, and honestly, because of, working at Sunrise and the other things I have going, it's honestly now about once a week.
Yeah, and that's perfect. And I think you mentioned something there, which is, expediting the learning curve substantially. So, when I get guests on here, I get to ask them and, have them extrapolate, a concept here and there. And I typically walk away with something that's really, really insightful. And I'm sure, you doing that is, of course, that times five, as you alluded to, is immense. I feel that way. And even doing the weekly show with Rob, sometimes I feel like from week to week, if you don't have a guest breaking in there here and there, and there's not that really much to talk about that's topical, it's very challenging to create concepts and ideas that are new, fresh, and different and interesting. Because there's so much, out there. There's so many other people to, put your time and attention into. So, it can feel a little bit vanilla doing it week in and week out, but it's very tough. But at least with a guest, it's almost easier for me to do this show than it actually is to do, the Lone Star Capital flagship show. But interestingly enough, that's kind of my experience there. And from that, did you kind of land, your situation with Sunrun where you have the partnership there, out of curiosity, from maybe speaking with Brian, or is that kind of separate?
Yeah, that did not come from the podcast. That came because of Raise Masters. So Brian's a coach at Raise Masters. Um, and they needed, found out through, I think Adam might have told me, or one of the guys over at Sunrise, or not Sunrise, at Raise Masters told me that Sunrise was hiring. And I reached out to Brian. We talked for like an hour. I had already kind of interviewed, but at the time that I had interviewed like 6 months earlier, I didn't think I wanted like a long-term job. It was still early in 2023, and I hadn't quite been dragged through the mud enough yet. Like 2023 did to a lot of people, especially
Right.
those of us that were new to capital raising. And so, fast forward 6 months, I've been, dragged through the mud, and I'm beat and battered. And I'm like, okay, Brian, like I'm in it for the long term, at least for a few years, if not longer. And so we talked on a Friday, and on Monday morning I had a job offer. So
It
yeah.
works enough. That's awesome. Well,
Yep.
switching gears now, talking about real estate once more, but specifically to you, what was your first real estate investment?
Yeah, my first ever. I mean, we'll not count the main residence, right? That never counts for net worth, so
Well,
that's
no,
not an
I'll count
investment.
that. I'll count primary. We will
Yeah,
for sure count primary as a investment because it can be treated as one, of course.
Yes, it can be. And ultimately it will become one when I sell it, hopefully this year, just because I just got really lucky with my timing. And, like anyone else who bought 5 years, it's been 5 years almost to the day I moved in early March. Um, it's basically doubled, right? And it's just kind of sitting steady somewhere in that 1.75 to 2x range, simply because of timing. And I put a lot of work into it. So certainly, there's some expense there, but, just good timing, being in the right area, being in a good market, much like a lot of real estate stories you hear, right? So that what I would say is my first one, but really my first ever investment was a land entitlement deal actually with Greenlight Equity. On the side, as they were kind of building up their apartment portfolio, they were doing these land entitlement deals. They're like, hey, we need a capital partner. Like, do you want to be it? Now, in hindsight, shout out to those guys. I still love them to death. Still talk to them all the time. But in hindsight, as a capital partner, and this is a lesson for you guys, if you're ever a capital partner on something and you're the only capital, you have a lot of leverage. In fact, you have most of the leverage because you have the money.
Yeah.
So we split it a third, a third, a third, because there were technically three partners, but I was the only capital partner. Probably should have been more like 50-50,
Yeah.
50 to me, and they could have split, 25-25.
Accordingly. Yeah.
Doesn't matter. It still ended up having like a 25% return in like 9 months, as those land entitlement deals can be if you do them correctly. Have not done one since, but it was a good investment, good return. So yeah, that would technically be my first ever investment.
That's awesome. So now, of course, the evolution of you is ever evolving in regard to, Cattani, to working with with the new group with Brian. But kind of tell us about, the deals you've historically raised for and how you view the world in that regard.
Yeah, great question. So the first one I ever did, as I'm sure you've probably had a few people from this ecosystem, was the TechVestor short-term rental portfolio. Sam Silverman absolutely crushed the fund one raise for them back in 2022. So partnered with a couple other girls, actually female members from Raise Masters, and raised about 650,000 right at the end of 2022, which actually worked out perfectly because as of now, it's still the last time we had 100% bonus depreciation. And then B, um, fund one is fully ramped up now. So the returns are starting to reflect that. And then since then, I've raised for oil and gas deal, and then I've raised for a mobile home park deal for Bryce Robertson. Your listeners may be familiar with him. So the way that I view it is I believe in diversification, and I believe in the correct diversification. So most of my investors are cash flow investors. And so that was kind of the big thing, right? TechVestor has not missed a quarterly distribution. So that's huge. Oil and gas is kind of obvious there. Energy is massive right now, especially as we're in this recession, especially as, we start to learn that some of these countries, their supplies are even smaller than they kind of led us to believe, AKA Saudi Arabia, and some of the Middle Eastern supplies are, not only their supply that they have on hand, but the supplies that they can tap into are starting to be a little bit more diminished than we may have even thought just a couple years ago. So now with the domestic production ramping up, it's starting to bode a very, very good opportunity. Now, I'm not an advisor. Obviously, you gotta seek advice out there, but until it takes, until Tesla can figure out a way to not use 500 barrels, 5 to 800 barrels of oil to get the Tesla into your garage, you guys, we're going to need oil. So,
Well, also, oil is a little bit of a misnomer as well and kind of misleading because everything we have is oil based. Okay. If you're creating plastics, petrochemicals, you
yep.
need oil and fuel there for that. So, in regardless, it's not going to happen overnight or in our lifetime. So there's always going to be a marketplace for that. And to your point, it's so cost effective or inefficient and frankly, not that environmentally and are unimpactful when you factor out making Priuses or Teslas, because they're mining materials from somewhere. It's not like you can just, extract it from a tree and it's ready to go. No, you are, from one way or another, disrupting some sort of system, ecosystem, if you will, to, basically get the materials associated there. So obviously not gonna get political, but there's a thought there. And the other kind of spectrum in the oil and gas, which is super interesting, is, the government incentivizes you in two aspects for investments from a tax break perspective. If you provide housing and oil, can you kind of talk about some of the accretive tax benefits that oil and gas provide?
Yeah, it's very, very unique. So if your listeners are familiar, you kind of have three buckets, right? Income buckets. You've got W-2, right? That's the most common. Everybody knows W-2. You've got portfolio. That's like your stock account is the easiest way to understand that. And you've got your third, which is your passive, right? So your syndications. Okay. So for the most part, most of your LPs, right, your limited partners, they're usually high income W-2 earners, right? So their ultimate goal is to get their passive portfolio and their passive income to match and or surpass their active income, because all of the tax breaks that come from your syndications typically go towards your passive income, right? So you invest in a syndication, you get a big depreciation year one. That goes against anything passive. Now, obviously, there's an asterisk there. And that asterisk is if you're a real estate professional, you or your spouse are a real estate professional, you can start taking that against your W-2 income. Now, not a CPA, so talk to your tax professionals there, but that's typically how it works.
Yeah.
Now, the advantage, to answer your question, for oil and gas is that the way that it's structured is when you invest in oil and gas, now this has to be direct drilling, right? When you invest directly in the drilling of oil and gas, you can actually join the syndication as a general partner. Now, what does that mean when you're a general partner? Well, A, you are exposed to the risk and liabilities of the general partners. Now, what are those? Well, those are typically going to be, for your most part, any kind of injuries or accidents that happen while the drilling is taking place. Now, the good news there is the insurance umbrellas, not only for all of the leasing companies that are leasing equipment, they've got insurance. Then you've got those of us that are, the owners of the wells. You've got, all of these big umbrellas. So to come full circle, it's very rare. In fact, onshore, this is not offshore, onshore domestic drilling, there has never been a case where the insurance coverage has not been enough to cover an accident. Therefore, a general partner has not been exposed, meaning an investor general partner has not been exposed to that risk. So what does that give you? Well, because you're technically taking on all that risk and liability, and because you're technically active, you therefore get the tax benefit of an active partner, therefore allowing you to take the depreciation against your W-2 income. Well, what does that mean? Well, typically in oil and gas drilling, you're seeing anywhere from 70 to 90 cents on the dollar being used, coming back essentially as depreciation in year one. So if you figure $100,000 investment, let's just say, 70,000 to stay conservative, that 70,000 now can be taken against your active income. If you made $300,000, and for me, a lot of the investors I had invested in the oil and gas were high income in like enterprise tech sales. Well, if you know about tech sales or sales in general, most of your money is coming from commission. Well, commission, it gets dragged through the mud. I mean, it
Correct.
gets like 37.5, like from the start. And then you're
It's
not even
brutal.
taking into account your state income, depending on what state you're in, blah, blah, blah. So typically, somewhere 45, sometimes 50% of your your income being just absolutely taken, being paid to Uncle Sam. So now you get to take 70,000 of that. Let's say you made, 200,000 in commission, right? What normally would have been 100,000 gone to taxes. Now you're getting about 30,000 potentially back, right? And we all know, and a big point I like to try to make is it's not always about making more money, but how much money can you keep, right? And these tax incentives are set up to keep more money. So you don't have to go out and try to make more, but let's try to help you keep more. And ultimately, that just puts more money in your pocket. So
Yeah.
that's really the big kind of full answer to why it's such a unique investment, and why more and more real estate investors are starting to invest in energy.
Yeah, well, and that's a really good point there. So, just out of curiosity, then, on top of the accretive benefit, what is the investment like? Is due to the fact that you get such a depreciation scheduling on that? Is there a little bit less of a return profile? Would you consider it to be a little bit riskier? How does an investor handicap it if they're kind of comparing apples to apples? Is it like a cash flow situation? Are they setting up like a 5-year term? I just have never learned about anything regarding oil and gas, so I'd be very curious to know how that structures and plays out.
Yeah, that's a great question. So there's two kind of main structures or components that you can invest in. There's kind of the direct drilling, and then there's what they call the gosh, and I'm going to butcher this because I'm having a bit of a brain fart, but it's essentially the kind of the cash flow, the basically once a well gets going, right? It's already, so you have two main. So the first one that I explained is kind of the exploratory, where you're going to go out, you're going to try to find the oil, and you're going to basically try to find the wells that are hitting. And obviously, the more wells you can drill, the better your chances are to find what they call a gusher, right? And that's an obvious term of what that means, right? It means a well that's got a lot of oil in it,
Yeah.
right? And then the other are kind of the working rights. That's what they call it. There, I knew it'd come to me. What they call the working rights. This is essentially, once you've already found a gusher, is essentially buying a percentage of that payout. Now, there's pros and cons to both. The first one, the pro, is that you get a typically much higher tax benefit because you're investing in the exploration. There's a lot more risk that goes into it, which therefore there's more reward, right? The reward being a little bit higher tax break, and ultimately at the end, typically a higher equity multiple. However, the con is that you're trying to find the oil. If you don't find oil, you're going to be SOL. Now, the good news is, and the one I raised for it was exploratory. However, they're drilling 18 to 20 wells. They've already hit on a couple of them. And with some of the capital that they earned already, they actually went out and bought some working rights to some wells that are already flowing, therefore giving us, the investors, a better return economic, because it's not a cash flow play. It's a bit more of an equity multiple. And the cash flow kind of ebbs and flows, with the oil and the working rights and the expenses. Whereas when you buy the working rights, not quite as high as an equity multiple typically, but a lot more consistent payout because it's already cash flowing. It's just like buying to put it into real estate terms, it's just like going and building development in like a tertiary market where you're like, well, the path of progress is coming this way, and the economics are in our favor in that it's got a net positive in migration, but there's not as many apartment complexes here, and some of the diversification in terms of jobs have not quite hit here yet, right? Maybe there's like one or two main jobs, maybe it's some factory stuff, whatever, versus going and buying into an already established market, already established asset, and all there are just raising the rents, right?
Right.
And
Right.
boom, it's cash flowing, right? That's the best way to put it. Well, one's going to have a much higher equity multiple than the other because you're developing and building it out, and you're basically starting from zero and, 2-3xing your money. Whereas the other, you're already starting and it's already cash flowing. So, if the market appreciates, great. But if not, we were able to raise rents and there's still cash flow. So that's kind of the best way to put it into real estate terms.
Makes sense. That makes sense. So, now moving forward, what investments are you wanting to raise for? And can you kind of give the background of kind of the new venture and what you're kind of looking at right now? Because it's a little bit different than maybe what we would want to live in. it's a little bit different from what I've ever invested in. So you can kind of walk through maybe the two options that kind of in the fund and, how you view the world.
Yeah, absolutely. So it kind of worked out perfectly because I had just done a mobile home park raise, and I'd always, I never hated mobile home parks. Just like I started looking at real estate right around 2017. And back then, man, gosh, of course we'd all be millionaires in hindsight, but
Right.
man, I would get like, I was on all these lists, and man, you'd get mobile home parks at like 12 caps, like just silly, right? Like whatever. But I'd always been like, okay, like obviously there's a return here. There's got to be something to it. So I never disliked it or never kind of thought, oh, I'd never invest in trailer parks. But ultimately, the last raise I did on my own was for Bryce Robertson, and it was a mobile home park deal. And so I started to familiarize myself with it. And man, they are just such a sound investment for a multitude of reasons. One, the biggest one is just a finite resource. Like you'd be hard pressed to find anywhere that's even developing them. The red tape and barrier to entry on development for these is just so high now. You got too much NIMBYism, right? Not in my backyard, right? Every market, every city wants affordable housing, but yet they just don't want it to be mobile home park. It just is. It just can continue to kind of have that bad rap. Now, that's good news as an investor because when you go and you invest in one, you don't have to worry about someone building one down the street and everybody moving out of your park and going to the shiny new mobile home park. Now, the other reason too is if you do develop one, you're not developing the houses, right? All you're doing is developing the land. So we like to say we're land investors, right? We're investing in the land and the infrastructure, the sewage and all of the things, right? The roads and the gutters, and some of them have pools and clubhouses and things like that. For the most part, these homes are owned by the residents. In fact, it's a lot more favorable when you get more tenant-owned homes than park-owned homes for a multitude of reasons, and I can get into that if you want. But ultimately, it worked out perfectly because when I raised for Bryce, it opened my eyes to what an incredible asset class mobile home parks are. And then B, it was a perfect segue right into joining Sunrise because that's all they do are mobile home parks and basically parking garages. But we're on Fund 4, and currently right now it's all mobile home parks, 2 acquisitions, and for the foreseeable deals we're about to launch in Fund 4, all mobile home parks. So
Very cool.
yeah.
Can you talk about parking structures as well? How awesome that is? Because the beautiful world of private equity space is that there's always a way to make a buck, and there's always a
Yeah.
way to skim margins, to improve operations, and to enhance value. So, I think I was at Raise Fest and was hearing Brian talk about, parking structures. Like that's brilliant. And of course, there's someone out there, perfecting that process, reinventing that wheel, and, figuring out ways to make a lot of money. And that's something that doesn't seem like it's probably an overly saturated space. So, can you kind of walk through the value and the play there and maybe how unsophisticated the space may or may not be actually?
Yeah, that's a great question. So it turns out it's slightly more sophisticated than you would anticipate. Reason being, you are dealing with like cities, right? You're typically in downtown metros. So, you know, for instance, the one we have in Phoenix, the Lures, uh, you know, like the courthouse is, has like a kind of a corporate structure tied to it where they'll like validate your parking. You know, it's the Phoenix courthouse, right? Like people are going there a lot. You know what I
Yeah.
mean? Whether it's jury duty or whether you're in trouble, you're going to the courthouse a lot. It's literally right across the street. So there's such a fascinating asset because much like mobile home parks, they're finite resource, right? You're talking about downtown metros. There aren't, there isn't more land in most of these downtown MSAs where you're able to just go build another parking garage. And honestly, that's not highest and best use of the land
I
anymore,
was
right?
thinking about that as well. Yeah, I was thinking
Right.
about, most people in urban areas like that, you have a very nice moat there if you can make it happen. Or, your other play is, okay, well, we'll just maybe turn this in if whether it's in Phoenix, it could be in an opportunity zone, but we'll just put units on this, right?
Yeah, I mean, worst case scenario, at the very bare minimum, you own a piece of land in a, downtown MSA, and one like Phoenix, which is still, net positive, has a lot economically in its favor, right? At its very core, you own, I mean, a very nice piece of real estate. And so to get into the actual asset itself, we've all parked in a parking garage, right? It's a big concrete structure, depreciates like a dream because literally the whole thing is just engineering, right? It's all rebar and concrete and paint, and
A
it's
couple computer systems, and that's really it, right? Not even a
right.
staff member in there. So there's like no payroll associated. There's no
No
toilets you're
payroll.
fixing there. Maybe there's an elevator, but that's really it. So repairs and maintenance probably super low. Maybe you put a security system in it, and there's really nothing there. If I had to go just top of mind without looking at anything, I'm sure there's a little bit more intricacies to it and systems associated with it, but it's not rocket science ultimately, I have to imagine.
No, not rocket science. Now, you do have to be careful about what markets you're in because, imagine being in the Northeast, right? That variable weather is, will play a factor. And, we actually we're looking at a deal there, I believe last year. And ultimately, the repairs and maintenance were somewhere like 130 to 170 a year, strictly because of the harsh, weather, right? You go from a harsh winter to all of a sudden it's 90 degrees, right? Everything's expanding, contracting, water starts to fill in there, blah, blah, blah. So I won't go too deep into that. But if you're in the right markets, which, we've got one in Clearwater, we've got one in North Carolina, and we've got one in Phoenix. Like you said, they don't require a lot. And when you get places like in Phoenix, when, the Diamondbacks are in the World Series, during some of those home games, because it's a dynamic pricing system. So as demand starts to increase, meaning more cars start to flood in, the price starts to go up. So you might start at $50, $55. We were getting up to $70 per car for, and I think there's like 438 total spots in that garage. So you can imagine that, around some of these events, and again, it's downtown Phoenix, you've got Footprint Center right there. Suns are playing currently right now. You got Kevin
Think about
Durant,
that.
D Book. You've got, when we were there doing an investor tour, Olivia Rodrigo was playing in a sold out. So you have all these events where all of a sudden you're like, holy cow, like in the end, there's literally one guy who works at the booth. During big nights, they'll have two people who help kind of exit, because what they actually do is they turn the in the inbound into an exit. So you actually have multiple exits now. That is one of sort of the only caveats, is you can't change anything, right? So like this was built so long ago that, the ingress egress is not the most efficient, but they're able to turn the ingress into an egress, make it a little bit more efficient for the exit. So as you can imagine, to kind of come full circle, low cost of maintenance, right? Not a lot in terms of your payroll. You do have someone on staff all the time, and there is a company that actually runs it, so it's their payroll. But you hold them accountable and like, hey, we know what it costs now to run this efficiently. You can't pull the wool over eyes and that, oh, we had to hire, 6 more people. It's like, no, you don't have to. So
Yeah. So with that said, what is the cap rate on like a parking structure, and like what debt profile do you put it in as well? Like that fascinates me to think about, how you handicap all these different assets, right? Because, a 5 cap in multifamily is not a 5 cap in, probably the self-parking game. It's not a 5 cap in the oil and gas. I don't like they even go off cap rates like that, or, but mobile homes, right? So everything is handicapped differently. So what is the capitalization rate for a typical structure going in, and kind of what you look to sell and exit? Is there even kind of a want to sell it? What's kind of the scheduling with that like?
yeah, that's a really, really great question. So I'm trying to remember off the top of my head. I believe it was somewhere around a 6 cap. The debt on it, it's normal, like commercial style debt, right? Long rate or long-term
Agency.
fixed rate agency debt.
Okay.
A little bit different, obviously, because, you know, it's not like a dwelling. So it falls a little bit more under the like self-storage style debt structure, but still obviously can get agency for it, no problem. So, you have all of that. And I don't know off the top of my head what our terms are, but I do know it's long-term, uh, fixed rate. And what's cool about it is we basically got a free business or a free office with it. So the lures, if you're familiar, I'm gonna educate you if you're not familiar on your
I'm
your
not.
Phoenix history. But the Lures Center is literally called the Lures Center because it is the center of downtown Phoenix. So downtown Phoenix is actually built around this asset. The business, the office part itself is actually a historical building. Now, not the whole thing, but like the windows are historical. Like there's kind of a little nuance to it, but it does have a plaque right outside of it, historical building. So we basically got that for free, and most of it's being renovated now, but some of it's being leased out. And what's nice is because we got it for free, we can we kind of kneecap the market and set our own terms. And so obviously we're going to be able to fill it, kind of no problem. So it ultimately kind of works out very much in our favor.
That's like an incredible little extra income addition to the piece there. And actually, it's kind of funny to kind of open up the umbrella and unveil the curtain here with Lone Star Capital. We were acquiring 1001 Ross. We were attempting to over the summer. About a year ago, we got the deal locked up, I want to say. And unfortunately, due to the treasury market running in the wrong direction, as we were all taking a bath, as you alluded to in 2023, drugged through the mud, no one was having their number one acquisition year that year, I would have to imagine,
Right.
unless you were literally a newbie or, just started in the latter half of 2022. But very challenging to make acquisitions work. Long story long, essentially there was a parking structure associated to the deal. And due to that structure being on the deal, it was interesting. It's a totally different entity. It's treated separately. It has its own management system there associated. So, some of our investors were cool with it. Some investors, were not interested in the nature of that because it's a different game. And, it's not apples to oranges running multifamily and then running, a parking structure as well. And, optimizing the space you have there from an income perspective. So we had, of course, the equity lined up on that one, but that was some pause that some people had for that there. But it just goes to show that, let the pros be the pros, let the experts be the experts, and really employ the right people to do what they're best at to maximize the value there. So with regard to, mobile homes and whatnot, what would you say just as a pitch to an investor who may think, ooh, mobile homes, I don't want to deal with those people or deal with those tenants. What do you say to those limiting beliefs and, objections when you put your kind of investor, and your sales hat on?
Yeah, that's a great question. So the biggest thing is, what are your goals, right? I think the biggest hurdle that I run into with investors, especially those who are new, right? They know they want to invest in real estate. They know they want to do it, but they don't even know what their goals are. And so too many people get so overwhelmed by finance in general, right? I mean, how many times do you tell people, right? Some layman, no offense to the layman's out there, but some layman, right, who, works in tech, right? And we're like, oh, what do you do? And I just, oh, I work in finance, private equity, right? And they're like, oh, I know nothing about finance. And then they stop there, right? And then there's you and I are like, oh, what do you do in tech? Oh, how does that work? Like, what is it that you do on a day to day, right? But as soon as you tell someone you're in finance, they like, that's it. I don't know anything. So the biggest thing to do is like, yeah, the stock market is as robust as you want to make it. I mean, you can get into derivatives that like, would blow your mind and people would be like, why is this a derivative? Well, because people get bored. That's why. But the big thing is, okay, what are your goals? All right. Well, especially to a young person, right? We're both young people. I've got at least another 10 to 15 years before I'm like, okay, I don't want to have a job or like, I really want to taper down. Well, that gives me a very long runway to start investing. That means for me, I don't need to be a cash flow investor right now, right? I want to chase a little bit more yield right now, right? Perhaps a bit more speculation, depending on, what do you want to call it, but chase a little
You're
bit more
allowed to be riskier the earlier you start.
bingo. And also, ultimately, what I'm trying to get at is once you want to invest in cash flow, it's much better to invest $1 million for cash flow than 250,000 or 300,000, right? So let's identify your goals And let's have a long-term outlook. Too many people get stuck on what happened in 2023 and ultimately what 2024 is going to be like. Right. I think we can all agree it's going to be a bit slower year. Guys, this is a mere 2-year time frame in the grand scheme of life, right? Over the next 10 years, that's literally 20% of the time. That's nothing. If 20% of the time things are not going that well, 80% they are, I'd say you found a really good investment. I'll take those
Yeah.
all day long. So don't get too caught up in what's happening in the short term. However, the thing you need to know is that when there's blood in the streets, that's the time to buy real estate. So here's what I tell people. If you're starting small, let's say you don't have enough to get into syndications and you just want to go out and you want to find a duplex, right? I realize rates are high, but you got to marry the basis and date the rate. What do I mean by that? Cost basis right now, meaning the entry price, what you're going to be able to buy that asset for, probably the lowest it's ever going to be right now. As soon as interest rates start to come down, and they will this year, those asset prices are going to start ticking up. So keep that in mind. Now, if you're completely priced out of the market, that's one thing. But if you're not, and you have to take a bit of, you know, if you have to thin out your margin a bit for the meantime while we wait for rates to come down, that's worth it to get that low cost basis, because in 8 months, 12 months, especially 18 months, you'll be able to refinance no problem. And all of a sudden that margin's going to increase. And oh, by the way, once prices start coming up, your equity is going up. So what may have just been a refi may end up being a cash out refi, whatever it may be. So those are the things that you really got to pay attention to. And don't be scared of a market. If you're scared, that means you're probably getting your news from mainstream media. And that's just the wrong place. You need to be listening to podcasts like this, talking to people like Craig, like myself, who understand the cycles and where we're actually at, and not some news anchor who's just trying to invoke fear in you and, wants a reaction. You want to get it from people who actually know what's happening.
Well, in our space too, we're allowed to be insiders. We're allowed to have information that most people are not allowed to have, if you're in,
Yes.
the mainstream equity market, right? So it's a super important, note there to
That's a
to
great
think
point.
about and to mention is, you want to play where you have an unfair advantage. And I think in the space that we are in, we kind of do have that benefit there, specifically pertaining to just what's going on as well and where we're at in the market. I think one thing to mention too is, now when hot money is not the best, although Bitcoin, funny enough, or new money, hot money, however you want to call it, Bitcoin is ripping, crypto is ripping, which is good. But, there's a little bit of a tail on real estate because it's a slower trading asset. It got super hot when it got hot, and then also it'll cool down a little bit slower versus, Bitcoin could drop, overnight. I mean, I remember basically, I don't know, 4 years ago on the day when Bitcoin went from 20 grand to 5 grand and then went to 60 very quickly after, right? So we've seen these kind of weird spikes going up, going down, but you don't really get that as much, obviously, in real estate because it's slow trading, and it trades on a different yield. But, I think right now is the time to really get excited about investing in real estate.
Mhm.
Not when, an individual is, theoretically telling you how great it is. Once the Uber drivers and this and that are starting to give you advice on something, it's probably the time to get out of it. So while people and less individuals are doing it right now, is the best time to kind of park your cash in it over the next couple of years. And then once people go full cycle is when it gets, more talked about, because people do, kind of follow trends and, inevitably maybe they're just not thinking about it. Maybe they've been snake bitten. But right now, as I said, is the time to kind of do it. Specifically for apartment complexes, what are some of the, or sorry, not apartment complexes, but mobile homes? What are some, pain points and kind of some misbeliefs or, wrong paradigms people have regarding investing in them as opposed to, like a multifamily deal or, homes or something a little bit more mainstream? Because I think apartment complexes, someone considering this an alt, it's almost silly. There's nothing alternative about investing in apartments. I think it's
No.
very, very original, but it's still considered the alt space, right? But, you start going to oil and gas, parking structures, and maybe, mobile homes, that's when it does feel slightly more alternative than mainstream. So can you kind of speak to some of the, misbeliefs a lot of people have regarding it?
Yeah, absolutely. It's kind of hilarious, right? How like it gets that misnomer as alternative investment. It's like, oh, but you invested in a REIT, and you're like, anyway. Um,
Yeah.
so and you're like, what do you think that REIT invests in? So yeah, right. I know. And you're like, oh, by the way, a REIT trades just like a stock and it's still only worth what someone's willing to pay. Doesn't matter what the underlying assets are worth. So enjoy that. Anyway, so the biggest number one myth is that they're not tax efficient from a depreciation standpoint. And the reason that myth exists is because, like I said earlier, for the most part, you really want tenant owned homes, right? So people think that because you can't take the home itself and depreciate it, that all of a sudden now you're left with, well, what are you left with? I don't understand. If the real estate itself is not there, well, guess what, guys? The only thing that can't be depreciated is raw land. Okay, well, as soon as you put a road on it, that can be depreciated. As soon as sewage runs under there, as soon as city water runs under there, that can all be depreciated. Well, now you got curbs, you got gutters, right? You've got the pad that the home itself is on. You've got septic tanks, if that's what you have. You've got, your clubhouse and your. So typically what we see, to kind of break that myth, you typically see anywhere from 15 to 20% of the total acquisition price is just the land. That leaves 80% left that can be depreciated. And oh, by the way, all of that can be on at the longest at 15 years. Well, if you guys understand how bonus depreciation works, as long as it's on a 15, 7, or 5, then it can be used in bonus depreciation. Well, that means that all of that can be used in bonus depreciation. So I would say that's the number one. Number two, you still get your people who call them trailer parks. I get it. I mean, technically they are a mobile home, right? It can be moved. It costs a lot of money to do that. Especially when you get up into the higher tier parks, which is typically what we're aiming for, your institutional grade. These have roads through them. They're subdivisions, guys. That's really all they are, right? A lot of them gated communities, so that's another big one.
You know what I've
And
also
then,
heard about
and
them as well is that some of the tenants are actually not as undesirable as you think. They just choose to live in this, asset as opposed to living in an apartment complex. Have you kind of seen that as well?
bingo, 1,000,000%. Yeah. One of the parks, we have someone who's lived there for like 45 years. And yeah, I mean, you're talking blue collar, pay, salt of the earth people. They pay on time, in full, every month, no complaints. They know that every year, it's going to go up 8 to 10%. And like clockwork, it goes up, boom, you know. And so, yeah, that would be, I think, probably the third misnomer is the demographic of people that you're dealing with. Now, don't get me wrong. You can find those people in there and everybody's going to have their bad apples. Trust me, when an apartment syndicator goes and buys a B plus asset, I promise there's one or two tenants in there who are a pain in the butt and they want to get them out. It's the same everywhere you go. It doesn't matter what asset class. Self-storage runs into it all the time, right? Doesn't matter. You're always going to have those people, but much like, choosing the right markets, we choose to invest in, although we're diversified geographically, we still choose the red states, the states that are landlord friendly, the states that allow us to evict bad tenants, just like that. And the great news there, just like in an apartment complex, you kick that person out, you get to move that pad rent all the way up to market. And now, just like that, you've got, 1, 2, however many there are, right up to market rent, and you've got good tenants in there. So I would say those are
Yeah.
probably top 3.
Yeah, no, that's a great breakdown. And, to your point about, having bad apples anywhere, that's not unique to just mobile homes. It's just subject to real estate and being a landlord.
Right.
And this is why if you're a passive investor or you don't want to deal with, having tenants, whatnot, that's great. That's why we get fees associated to what we do. This is why we have upside in carrying these deals, is because we're doing that kind of painstaking process of collecting rents, dealing with that. And another thought that you kind of brought to mind right there for me is just thinking about how some of these investors, want to invest in distressed deals and then maybe freak out if, some of the tenancies are bad or collections bad. Well, it's like, yeah, that's why it's called distressed. That creates the
Right.
opportunity. So you need to be patient regarding that turnover and takeover process. So that's not just subject to mobile homes, that's in apartments. There will probably be a shooting or two at one of our properties potentially in Texas. I don't say that, with pleasure, but I just say that as likely a fact that may in fact occur. And that's just part of the game.
We have to deal with a lot of what we acquire are in the Midwest. We have to field constant questions about tornadoes. Like, there's always going to be something, you know what I mean? And, yeah, listen, if you got sucked in by the 3.5x equity multiplier, and then all of a sudden, your quarterly update comes and, they're 30% vacant because they had to clear out, 30%. And you're wondering why distributions are paused a little bit longer. Well, that's what you get. That's how
Yeah.
that's going to go when you want it, when you want to get into your C minus and whatnot asset class. Yeah, there's a lot of upside there, but you're gonna have to be willing to deal with, you know, with the downside. And that's why you guys got to remember these hold periods are long for a reason, guys. You can't come in and implement you know, a value add business strategy in 9 to 12 months, right? Like,
That's not
sure,
realistic anymore.
does it happen? Yes, it does. But those unicorn days, shout out to Rise 48, who seem to just do it with every deal. Um, Obviously not a knock. Those guys are obviously doing incredible things. I absolutely love Zach and his whole team over there. But yeah, those days are kind of gone, guys. So be ready for full hold periods. That's just the nature of where we're at. And these are illiquid by nature, but for good reason, right? You got to give your operators time to actually operate.
Yeah, without a doubt. I really like that. And I think we're all going through a retraining, recalibration process. And you've obviously partnered up with some of the best people in the business. I feel like I've done the same here in our respective spaces where, we don't even want investors that are looking for, the highest return. I kind of tell new partners now, hey, if you're looking to get, comped out the highest from a fund manager perspective on projected promote, or if you're an investor chasing the highest IRR, it was great talking with you, but we're not the right fit. We want you to value for the value proposition that we can bring. And I want to set that tone very early on that if you're just chasing the higher R, you're just chasing a lie, because ultimately, there's no free lunch. Okay. You're basically just believing someone's projections and ability to execute or not when you make an investment. Of course, arithmetic is associated and, the math needs to check out in pencil, but make no mistake, chasing the highest number means you're opening yourself up to more scrutiny. Okay. Final couple questions here. You've been so great to be on the show. What is making you most excited about the looming recession and the opportunities coming up? Because you've obviously lined yourself with great people, and now should be the time mobile homes really thrive, right? But I'd be curious to know if you have any, inside takes or, a different frame of reference than, the inevitable.
Yeah, I mean, ultimately, like you kind of alluded to there, in the end, at its very, very foundation, it's affordable housing, right? So, affordable housing without any of the government intervention, which is really right where you want to be, especially in a cycle like this. And ultimately, what's happening is, you had a lot of multifamily operators who thought the mobile home park operation looked easy, and so we're getting a lot of deal flow from, in fact, the acquisition we just closed on, that exact story. They're multifamily operators, basically learned, I think, maybe a little over a year into it. I think they're about a year and a half into it, that not as easy as they thought, and they're going to stay in their lane. So ultimately, I'm honestly excited, right? For every asset class, this is really awesome, especially in the living space. I've kind of checked out of self-storage, so I'm not going to speak to that, although I would imagine, obviously these times are great for them too. But in terms of like multifamily and mobile home parks, this is just such an incredible time because the tide is going out and we're seeing who's swimming naked. And those people who are swimming naked are more or less giving away their assets at fat discounts. And those of us, Sunrise, Cattani Capital Group, Lone Star, who have positioned themselves very well, are taking full advantage, and the investors are going to reap the benefits. Now, again, don't let these last 2 years, or ultimately will be probably 2.5 years of, kind of low transaction volume, high interest rates, right? Don't let any of that fool you. This is actually the right time, and it's gearing up. You can just feel it. If you're in the industry, it's almost like palpable, right? You're going to these conferences, people are getting more excited. The reason is because those that weren't able to implement their business strategy, or had bad debt, or weren't able to, work with lenders new to the industry, they're about to be booted out, offloading their assets. And those of us that are positioned well are going to get to take advantage. And you, the investors, also get to be a part of that advantage. So I think that's what excites me most, because I don't believe the discounts and some of the blood in the streets are quite over yet. And for those of us that are positioned well, we're licking our chops.
I love it. You've been so great. Where can they find you? Where can the audience listen to your podcast, reach out to you if they want to learn more about investing with you and the various ventures you've been in?
Yeah, absolutely. So best place to find me is on social media at Johnny Cattani, JonnyCattani. I'm pretty much on every platform, but most active on LinkedIn and Instagram. And then you can listen to my podcast, the Cashflow Chronicles, on all your favorite platforms.
Awesome. You've been great. Thank you so much for coming to the show. For the audience tuning in, thank you so much. See you next week. Peace.
My man.